All right, welcome to Talk Tickers. Today we are digging into Franklin Covey's Q1 earnings. And wow, this was a report that really told two completely different stories, and it sent the stock on an absolute roller coaster.
So here's how we're going to break this all down. First, we'll hit the headline numbers. Then we'll get into management's big transition story. After that, we'll look at how the market reacted, because that was pretty crazy. We'll weigh the bull versus the bear case, and then of course, we'll wrap it all up with our final call.
All right, first up, the headline numbers. And right out of the gate, you're going to see the big contradiction that defines this whole quarter.
Okay, so on a GAAP basis, this quarter looked ugly. We're talking a loss of 27 cents per share. Now, to put that in perspective, the street was expecting a small profit, so this was a miss by over 30 cents. I mean, that's the kind of number that typically gets a stock just crushed.
But that's not the whole story. Not even close. See, when you start stripping out some of the one-time costs, things like restructuring charges from them shaking up the business, the narrative just completely flips. Adjusted EPS actually came in at a positive 7 cents. That's a beat compared to the 3 cents Wall Street was looking for. So you've got this huge question hanging over everything. Which number do you believe? The ugly headline miss or the solid underlying beat?
And if you look at the other metrics, well, they definitely lean towards the negative story. Revenue was light, missing what analysts expected, and both adjusted EBITDA and free cash flow took a pretty big hit compared to last year. So yeah, on paper, this looks like a really tough quarter, no doubt about it.
So how in the world does management explain all this? Well, they came out with a story. They basically said, look, this was a transition quarter. The idea is that these ugly reported numbers, they're just hiding some real, fundamental strength that's building up underneath. The message from the CEO, Paul Walker, was super clear. He basically said the hard part is over. The big transformation they've been working on is done, and now finally the good stuff is starting to bubble to the surface. Not in the reported numbers just yet, but in what they call their leading indicators.
Of course, talk is cheap, right? So management knew they had to show some proof. And they did. They pointed to a few key forward-looking metrics that they say are the real signs of a turnaround.
Okay, first up, and this one is a really big deal. Invoiced amounts in their core North American business grew 7%. Now, why does that matter so much? Well, in the previous quarter, that same number was down 26%. So that is a massive, massive swing from a big negative to a solid positive. That's the kind of inflection point you love to see. Number two, they're bringing in new customers again. And that's huge. Invoices for new logo subscriptions jumped by 25%. This is the evidence they're pointing to that says, hey, our sales changes are actually working. We're getting new business in the door.
And third, check this out. Services bookings were up 29%. That's another one of those key leading indicators. It suggests that clients aren't just signing up for a subscription and walking away, they're actually engaging deeply with the company's services.
But here's the real kicker. They backed all this up by reaffirming their full-year guidance. They didn't lower their targets for revenue or for adjusted EBITDA. That's a huge vote of confidence for management, basically telling the market, we believe these positive signs are real and they're going to turn into actual reported results later this year.
So you have these two totally different stories, right? The ugly reported numbers and the optimistic future. So how did traders react to all this? Well, you can probably guess, it was a total roller coaster.
And this chart just shows the confusion perfectly. Right after the numbers hit, the stock tanked almost 10% in after-hours trading. People saw that big gap miss and sold. But then, as management started talking on the conference call and telling their story, the stock started to climb back. And by the end of the next day, it had recovered everything it lost and even finished a little bit higher.
So what does that tell you? It tells you the market sold the numbers first, and then it bought the story. Initially, it was all about that weak reported quarter. But in the end, investors decided to put their faith in management's green shoots narrative and that promise of a stronger second half.
And all of this really sets up a very clear debate for this stock going forward. It's really a classic investor dilemma. Do you focus on the weak results we're seeing right now, or do you bet on the future that management is promising?
So the bull case is pretty straightforward. You have to trust management. You have to believe that the reaffirmed guidance and those strong leading indicators are the real story. And hey, the fact that they're buying back a ton of stock helps provide a floor. The bear case, it's even simpler. The numbers we can see right now are just plain bad. Cash is flowing out of the business, and there's a huge execution risk here. I mean, can they really turn those positive signs into actual profits?
So, where do we land on this? What's our call? After this tale of two completely different quarters, which story wins out?
Look, right now the market is giving management the benefit of the doubt. But that won't last forever. The next couple of quarters are frankly make or break. They absolutely have to prove they can turn those nice-looking leading indicators into actual, clean revenue and positive cash flow. The story sounds good, but now it's all about execution.
So for us, our rating is market perform. We can't go with an underperform rating here because those leading indicators and the reaffirmed guidance are just too strong to ignore. But at the same time, there's no way we can call this an outperform. The execution risk is just too high, and the current financials are too weak. We need to see the proof, the actual proof on the income statement that this turnaround is real.
And that's our take on Franklin Covey's very, very eventful quarter. As always, this is not financial advice.